Good morning. Today is Wednesday, October 1st, 2025. This is the Arlington County Board of Equalization hearing. All 5 board members are present and there are 5 cases on the agenda. We'll start with the first case, which is RPC 2500712A at 911 South Scott Street. Ms. McCraw, you can start with your 8 minutes and tell us about this property.
Thank you very much and good morning. Good morning, Ms. Shuttlesworth. The subject property is a 247 unit Class C multifamily apartment building. It was built in 1991 and it's located in the Penrose submarket of Arlington, and it's known as the Columbia Crossing Apartments. Beginning on page 101 of the BOE memo, this is where our analysis begins. The 2025 proposed assessed value is $89,351,700, and our 2025 requested assessment is $74,919,000. Moving down to pages 102 to 103, we just have a brief written narrative summary of our appeal issues, but our analysis does begin on page 104. As of 1/1/25, the data value, the subject property was about 6% vacant. 15 of the 247 units were vacant. Over the past year, the property has averaged 8.5% vacancy, and it suffered about $661,000 in income loss due to vacancy and collection and concessions, which equates to about 8.6% in income loss. Over the previous 3 years, additionally, the subject property averaged about 10% income loss due to vacancy and collection and concessions, and this summary can be found on page 105 of 174 of the BOE memo. Per the guidelines, the tax year 2025 Arlington commercial guidelines, mid-rise apartment buildings are automatically given a 4% vacancy and collection loss deduction across the board. For this property, we do believe that doesn't go far enough, but as you can see in our analysis, we do stipulate to the 4% vacancy and collection loss deduction here to stay consistent within the guidelines, and we make some slight changes to the gross potential market rent here to kind of account for this income loss due to vacancy and collection. Again, the subject property as of 1/1/25 was 6% vacant. It averaged 8.5% vacancy over the past year, and its income loss due to vacancy and collection amounted to almost 9%. So again, we do believe a further adjustment due to vacancy and collection is required here, but in our analysis, we do make this adjustment within our potential gross income for apartment rents. Just moving down, we do make a slight adjustment to the expense ratio here. As you can see in our trailing 3 years of historical income and expense information, the year in 2024 expenses amounted to $1.7 million, which equates to about a $7,088 per unit figure. In our analysis, we do increase this to $7,100 per unit for expenses as compared to the assessor's original $6,500 per unit. The 2025 market guidelines here do indicate that mid-rise apartment building with an effective age of 1999 would be entitled to a $7,350 per unit adjustment here, so we're well within the guidelines. Our resulting NOI after these adjustments are made of $5.2 million does align almost exactly with the year in 2024 NOI of $5.2 million. The assessor in the original worksheet is just slightly above that, about $100,000. Our final change here, again, as we've mentioned previously, is just with the base cap rate. It's our opinion that the assessor's base cap rate, as indicated in the apartment guidelines of 4.767%, do not reflect market conditions, as well as the sharp increase in interest rates by the Fed since March of 2022. We have discussed this in previous cases, so I won't delve too deeply, but I will say we use the band of investment to calculate a Class B/C base cap rate of 5.75%, which you can see on page 106, which we use in our analysis. Again, as we've mentioned previously, the PwC year-end 2024 investor survey indicates a cap rate range of beginning at 5%. So the assessor's base cap rate of 4.7% is well below this range. Again, on page 107, we have the market cap rate graph, which shows the trend that we're discussing here, a sharp increase in cap rates from fourth quarter 21 to fourth quarter 24. And again, on pages 109 to 110, we do show the trend of the deviation between Arlington County cap rates and what investor surveys are indicating for cap rates. Once those adjustments are made, we do arrive at our indicated value of 79 million. Again, the bulk of our appeal arguments here is just with the vacancy and collection, which we do not believe the county goes far enough to adjust, and with expenses. So with that, I'm open for questions, and thank you.
Okay, thank you. Ms. Shuttlesworth for the county, please.
Yes, good morning, board. Good morning, Ms. McCraw. So Ms. McCraw provided pretty good description of the property. I don't want to repeat her words. I will just add that the effective age is 1999, and the amenities include 24-hour fitness room, residential lounge, community center, outdoor pool, and the conference room. Lori Roskin did inspect this property back in August 2024, and the issues on appeal are vacancies and collections, OPEX, and the cap rate. In 2022, the property was renovated, including residential units and exterior components such as siding and roof. Some major mechanical components were also replaced, specifically HVAC and water heater. Looking at the summary sheet, we can see that post-renovation increase in 2023 potential rent, which is column C. That potential rent increased by over 8%. The rate of an increase in potential rent in 2024 did decelerate. However, it still showed a positive year-over-year change of 1.35%. The vacancy and collections reported for the past few years were above our stabilized figure. We did consider that fact. The 2023 vacancies and collections are particularly high, over 13%. We believe such high percentage was partially triggered by the ongoing unit renovations. The 2024 vacancies and concessions went down to 8.6%, which is still considered excessive. And to address this problem, I factor in 4% excess vacancies and concession. As the board can see in our column F, I did lower the potential rent projection by simply taking the potential rent off of the rent roll provided, and I just took off the 4% excess vacancy. So that figure that the board can see in the test column, that already took care of the excess vacancy and collection. Another issue we had to address in our test column were the operating expenses. As the board can see, DREA's OPEX used in 2025 valuation was understated. As the board can also see in our test column, we increased that OPEX figure. Our tested OPEX is actually significantly higher than the OPEX projected by the appellants in the pro forma. The 2024 NOI increased by over 8%. Our NOI projected increase of 2.5%, much lower than what was reported. And lastly, the 2025 assessment went up by less than 1.5%. With all that, I'm open for questions. Thank you.
Okay, thank you. Questions from board members? No? Okay, Ms. Shuttlesworth, if you have any final comments in your minute to wrap up.
Yes, thank you so much. Again, this property was extensively renovated back in 2022, which had a positive impact on the potential rent. Our tested potential rent factored in a 4% excess vacancy and collection. Our OPEX that we tested was significantly higher than what the appellant projected. The 2024 NOI increased by over 8%, which is almost $400,000 wise. Our projected NOI shows only 2.5% increase. And again, the 2025 assessment did go up by less than 1.5%. In respect to the cap rates, again, we relied upon third quarter 2024 publications such as RERC, PwC, and CBRE. All these sources are included in the BOE packet. Thank you so much.
Okay, thank you. And Ms. McCraw, if you take a minute to wrap up, please.
Yes, thank you very much. We do appreciate the assessor giving this a second look. And I would like to point out that per the rent roll as of 12/31/24, the actual in-place rents for the apartment plus market rents or the vacant units at market rent account to a total gross potential income of $6,758,000. That's in line with the assessor's test sheet column F, their annual potential gross income here. But the assessor still only deducts 4% for vacancy and collection loss. Again, despite the renovation as of 1/1/25, the property was 6% vacant. It averaged 8.5% vacancy over the past year, and we believe that this 4% deduction does not go far enough. Thank you.
Okay, thank you. All right, it's just among the board. Focus on this. Mr. Mendez.
Yeah, initially I thought the expenses looked a little bit low, but in column F, in the test column, you look at the GPI that they're using the second time around, it's a lot higher than the initial assessment and even lower than what was reported. So I think I'm okay with current assessment, all things considered.
Mr. Hoffman?
I think it's pretty good with the county's number.
I agree. I thought expenses were low, but it does balance back out. I originally looked at increasing expenses, probably $1.25, but on the assessment, but I don't. After really going through it all, I don't think it needs it. It balances.
Yeah, I think we're on the same page. I did
Yeah.
the same as you and tested a couple of numbers, but I don't think, I mean, that would bring the value below last year's, and I don't think.
No, I don't think.
Correct. So I'm okay with it.
Somebody need to make a motion there?
Sure. I'll move that we confirm the county's 2025 assessment at $89,351,600.
May I have a motion to have a second?
I'll second it.
Okay, motion and a second by Mr. Penaranda. All in favor?
Aye.
Opposed? Okay, it's unanimous. The county is confirmed at $89,351,600. Thank you both.
Thank you.
Thank you.
Right, next, we need Mr. Peralta and Mr. Harmon. Okay, there we go. Next case on the agenda is RPC 18038020 on North Carolina Courthouse Road. Mr. Harmon, you can start with your 8 minutes and tell us about this property, sir.
Yes, thank you, Madam Chairwoman, members of the board. Rob, good morning. So 1320 Courthouse, this is a 360,000 square foot office building. It was built in 1990. Now, if you'd be so kind as to turn to page 67 of the appeal, you'll see that the owner had started to market this property for sale with a professional brokerage firm, Transwestern, in the second half of 2024. As of December 11th, 2024, the seller had received 7 best and final bids for this property. These bids range from a low of $30 million to a high of $46 million. So just 3 weeks prior to the date of value, December 11th, 2024, the owner had received 7 best and final bids from market investors, and these bids valued the property at highest at $46 million. The owner ultimately negotiated up and accepted the best bid at $47.5 million, and the property went under contract right at the end of 2024, beginning of 2025. So we have 7 second round bids, best and final bids received for the property just 3 weeks prior to the date of value on December 11th, 2024. Those bids again range from 30 million to ultimately 47.5 million, with an average value based on the market participants of $43.2 million. That compares with the current assessment for this property at more than $69 million. And then the county's review, where their estimate range comes in up to $100 million. So quite a discrepancy. The county's saying it's worth between $69 and $100 million. The actual market, when they're receiving best and final bids, December 11th of 2024, is saying the property's worth between 30 and 47.5 million. So the exercise we're tasked with here today, of course, is determining the fair market value of the property as of January 1. In Virginia, fair market value, of course, is defined as essentially what a willing buyer would pay and a willing seller would accept in an arm's length transaction, again, as of January 1, 2025. So in this case, we're fortunate. We don't have to speculate what would they value this at. We have this exact fact pattern at this property. The seller willingly took the property to market in the second half of 2024 with a professional brokerage. The seller received 7 best and final bids dated December 11th, 2024. Those bids from market investors range from 30 million to 46 million. Ultimately, the owner did negotiate one of the bidders up to 47.5 million, and the property did go under contract at the end of 2024, beginning of 25 at that rate, 47.5 million. So we know the value that a willing buyer and a willing seller would trade this property at. At most, it's $47.5 million. Now, the advertising flyer for this property when the Transwestern took it to market notes that it has optionality for a new owner. This property was only 18% occupied as of the end of last year. The flyer states the owner, has optionality. They can maintain the asset as an office with high quality amenities that were recently renovated. A potential buyer could convert the property to residential, or a potential buyer could redevelop to higher density residential or condos or hospitality. So really what they're marketing it as is saying, hey, you've got options here, as with any office property. We just redid the amenities. We're trying to lease it up as office. Or we're only 18% occupied, you can redevelop it. There's options. And this is consistent with Arlington County's own analysis of the office market. So Arlington County Economic Development published a report multiple times in 2024 stating that 51% of the office market is either in distress or at risk of distress because of high vacancy, and that conversions of office properties should be aggressively considered and pursued. The purpose there being to drive down Arlington County's high vacancy rate overall. So Arlington County's own studies are saying, hey, we need to get more conversions. We need optionality. We need to do exactly what they're marketing this property as. If you can lease it up, great. If you can't, convert it. Let's get this solved. So this property, again, was 82% vacant as of the date of value with an additional 6% of NLA. The tenant was in default, effectively putting the property at 88% vacant. So that tenant hadn't paid rent since November of 2023. This property, again, had recently renovated the common areas, including the lounge, the lobby, the conference center, and the gym. The seller had been actively marketing the vacant space for lease with Cushman & Wakefield, also advertised on CoStar. The owner went so far as to invest money white boxing the 9th floor to use as a show floor for potential tenants. So you have an office building with effective 86% vacancy, recently completed renovations to the common areas, recently invested in a new showroom floor for potential tenants, being actively marketed by a professional brokerage for lease up. There's optionality to this property. Of course, all the results of all those investments, all those marketing efforts for new tenants, it was still 86% vacant. So knowing all of this and knowing that the best and final bids that came from that sales effort did come in on December 11th of last year between 30 and 46 million, property ultimately going under contract at 47.5 million right at the end of last year, beginning of this year. How does that compare? How does the assessment come in at 69 million? And how does the county's review determine a value of 100 million is even appropriate? Again, we're trying to determine how the market would value this property. We know from the December 2024 bids that the market valued this property at less than half of this range that the county's presented of 69 million to 100 million. Well, starting with the county's assessment, first the assessment assumed the property was only 68% vacant. It was actually 80% vacant, and then it had that other tenant who was in default not paying rent. Second, the assessment failed to account for that tenant not paying rent going back to November of 2023. The assessment actually imputes about $1 million in rent for that tenant. That's rent that the owner had not been receiving going back to 2023. Third, the assessment actually increased the market rent on vacant space from last year, despite no market evidence that market rents had increased over that time period. Last year's assessment imputed vacant office rent at $36.88 a foot, which the assessment increased, county's test increased. even further. Again, there's no market support for that. That's how we get this range of 69 million to 100 million from the county, which actually bumps up against the market range of 30 to 47.5 million. Next, the assessment overstated pass-through and parking income by $309,000. That's a non-equalized methodology that the assessment's employed. Fifth, the assessment shows a cap rate that is 114 basis points below what the county's expert concluded is appropriate for an average office building in the county. This property was effectively 86% vacant. It's not an average property. It's not better than average. Finally, the assessment failed to account for the cost of reaching stabilization at the property. The assessment assumes a 1-year lease-up period. Again, it's 86% vacant. It's in a market that Arlington County Economic Development states is 51% distressed. It's in a market that's seen 5 straight years of negative net absorption. 1 year is not appropriate for that. And finally, the assessment assumes TIs of just $90 a foot. We inspected this property in 2022, again in 2023. The vacant space is largely heavily used second generation space that will need to be rebuilt at market rates. Thank you.
Okay, thank you. Perfect timing. Excuse me, Mr. Peralta for the county.
Yes, thank you. For this property, I just want to clarify or make sure that the board is looking at the correct summary sheet. I believe Mr. Harmon was saying $100 million. On our TRIA's test, we're at 85,148,100. There is a correction there where the final value should be a reduction of 61,972,700, and what that shows, or that result is a change in the excess vacancy deduction. I believe we had originally 43,927 square feet. That value, that amount should be 183,588 square feet. And I can go through the different rent loss, TI, leasing, and rent loss if the board would like. But the final value is 61,972,700. And that represents an additional 10% reduction based on the original assessment. Going back to the history of this property, we do see that in years 2021 and 2022, the property was somewhat stabilized at 22.6% vacant. And now currently we do and understand that the major tenant, Arch Properties, that had 139,661 square feet in the building, vacated early. They terminated their lease. They did pay a termination fee that you see in 2022 and 2023, which equated to about $2 million for the remainder of the lease per year, $2,067,300 each year for the remainder of the lease that was to end in November 2026. Overall, looking at this property, I guess the decrease in NOI that I just mentioned, the change, is representative of 66% decrease in NOI if you compare to the 2022-2023 NOIs that were reported for this property. That's a 66% decrease for a property that increased in vacancy about 50%. We believe that the new value at 61 million is supported. We did see that we did inspect this property in 2023. As noted, Mr. Harmon spoke to the 9th floor is the only floor that was white boxed. And we believe that the $90 per square foot is supported as well. So with that, we are supporting the new value at 61,972,700, and we're open for questions. Thank you.
Okay, thank you. Ms. Dooley had to step out for a little bit, and we're going to continue with the meeting. Do we have any questions from the board? Mr. Mendez?
Yeah, for Mr. Harmon, can you talk more about you said there was a contract for 47.5 million. Has that closed?
So that contract fell out during due diligence. It went under contract again and did close in July of 2025 at 32.4 million.
Thank you.
Any other questions?
Yeah.
Mr. Huffman?
I think, Jordan, you referred us to a page in the package, like with Transwestern information, but I don't see it in there. Or were you
So
just describing the marketing?
I was just describing the marketing, so
Oh, okay.
I don't
All right.
believe it's in the.
I was looking for it. Okay. I guess that's it.
Okay, thank you. Any other questions? No? All right, we'll go to wrap-ups. If you want to take 1 minute, Mr. Peralta.
Sure. The county's new position is at 61,972,700. Again, that represents a 66% decrease in NOI when compared to 2022 and 2023, and compared to the 50% increase in vacancy from those same years. So we do ask that the board approve the revised assessment of 61,972,700. Thank you.
Thank you. Mr. Harmon, you can take a minute to wrap up, please.
Yes, thank you. So we know how the market values this property as of January 1, 2025. The owner received 7 bids, December 11th, 2024, 7 best and final bids that valued the property between $30 and $47.5 million. The owner did accept the best of those bids at $47.5 million at the end of 2024, beginning of 2025, and went under contract. Ultimately, during due diligence, that did fall out. The property did close with another bidder in July of 2025 at $32.4 million. Now, that value is the market. You know, it was widely marketed. It was a lot of interest from the market. I believe first rounds, there were even more than those 7 bidders. So the 7 bidders with best and finals came in between 30 and 47.5 million. The property is 86% vacant. That's where you get those values. It's in a market that Arlington County themselves
Excuse me,
put out a report saying that it's over 51% distressed.
Your minute is up. Thank you. All right, it's among the board now. Where do we stand on this? Well, I'll start. I mean, you know, this is something that it's totally new. I wish I had some more information on the marketing. The building is being going up the same way. You know, we reduced it last year based on increasing the cap rate, I think. And, you know, I don't see anything that I can make an adjustment based on just, you know, the new information that is being marketed and at offers. And, you know, we don't have anything on that. And again, you know, I think the burden of proof is on the appellants in any case. I'm okay with the additional reduction that Mr. Peralta indicated to reduce to 61,972,700. Mr. Hoffman?
Yeah, it would be really helpful to have the offer matrix and at least some materials from the broker, just to make sure that I mean, you're testifying to it, so I believe you, Jordan, but I've seen before kind of quasi on market, quasi off market brokerage, you know, just depending on who the seller is and what their preference is, they can keep it quiet and you might not get all the bids. So it's hard to nail it down and say that was the absolute best, highest bid without that information. But I mean, I would support a reduction to the contract price. I just don't know how to get there with this board. There's no way it's worth $69 million. There's just no, or 61 even. It's like there's no rationale for why this building could be worth $61 million in a reasonable analysis. 10 out of 10 professional appraisers would agree with me.
Increase the over 100% vacant.
Yeah, I mean, unfortunately, we don't have any additional information. I don't just want to go on, you know.
Well, the fact is, it is very vacant. That's the only thing I can think is, if, I'm not sure with another, 50 basis points, because they do put the 100% in there, or excuse me, 100,000 square foot vacancy, that maybe that needs to be more.
Yeah, I agree with everything that was said. I don't think it's worth 61 million. If they close it's 32, I mean, I'm pretty uncomfortable with that, but I don't know where to make an adjustment. I tried to bump the cap rate in the original assessment, 50 basis points, but it's even higher than the county's revision at 61 million. So,
Right.
and again, the burden of proof is on the appellant. I wish we had more materials on the sale. It was in the middle of the year, and typically in the past, we've said, hey, we'll revisit that next year, but at double the sales price, I think that's an issue. Almost double.
I mean, it's still a reduction from, when we came last year to the value. So
I realize it is a reduction. I just don't see it's that value. I don't care if it's reduced or not, so.
but again, I think, like Mr. Mendes said, the burden of proof is in the appellants. And we don't have anything else, just based on that and, based on what we feel it can be worth, or, I don't feel comfortable just making a change just on
Well, that's the only
thing
thing.
it's worth,
That's the only thing I was trying to hang my hat on a little bit is not just excessive vacancy, very excessive vacancy.
Right.
And maybe that's the other thing to consider, because it is, well over the 200,000, let alone, that's the only place I could see doing it.
Right, but if you look at the original assessment, even if you add another 100,000 square feet,
Yeah, but then
as a reduction, it's still higher than what the current, the new number that the county is providing. That would only reduce by $2 million, approximately, to 67. So,
yeah,
I'm okay with the new revised number that the county has.
even though it's probably very wrong.
Well,
I know.
We have to go with what we have, not just, but, okay, we feel it's bad.
When I first reviewed this case, I thought it was,
Right.
pretty apparent, like just based on what was reported in E1, or excuse me, the reconstructed column and the NOI that the county was using. I thought that was much lower. So I was, initially I thought that there probably wasn't going to be much of a problem. It's really just the sale for me but we don't have in my opinion, enough
Right.
on the sale to take it fully into account. So, I think I'm with you, Mr.
And
Mayor.
again, that's something that closed this year, so I'm sure.
Exactly, yeah. On top of that, yes.
I hope it shows up for next year's
Certainly.
comparison.
I'm gonna move to reduce the assessment to the new number provided by the county of 61,972,700. Second.
Yep.
Mr. Mendez, all in favor? I mean, if not, it's just gonna revert it back to the. So. Opposed? Mr. Hoffman? Okay, so the vote is 3-1. With Mr. Hoffman voting no. The reduction is to 61,972,700.
Based on the county's record.
Based on the county's new recommended number, yes. All right,
All right, thank you,
You're
Mr. Penaranda. My apologies, I had to step out, middle of that case. Okay, the, next case on the agenda is RPC 1505911. I understand, Mr. Harmon, you wanted to withdraw this case.
That's correct, yes.
Okay, and Mr. Brault, I assume no objection.
No, thank you.
Okay, I will move to accept the withdrawal. Do I have a second?
Second.
Sure. All in favor?
Aye.
Aye, opposed. Okay, that's unanimous, that's withdrawn. And just on the same theme here, the last case is RPC number 5 on the agenda, RPC 350200029, 2521 South Clark. Mr. Harmon, that one also you want to withdraw?
That's correct, yes. We sent yesterday morning.
Okay, any objection, Mr. Peralta?
No, ma'am. Thank you.
Okay, I will move to accept the withdrawal. Do I have a second? Mr. Mendez, second, all in favor? Aye, opposed, none. So that case is also withdrawn. The last case on the agenda is RPC 1603933, 1601 North Kent Street. Before we start, just to note for the record that Mr. Hoffman has a conflict on this and will not be participating in this case. So it will be down to just the 4 of us. Okay, so with that being said, Mr. Harmon, you can start with your 8 minutes and tell us about the property.
Yes, thank you. First, I do want to request on the record a copy of the county's revision that they presented orally at today's hearing, just so that we have a record of what they were presenting as a revised value, since that was not provided to us. 1601 North Kent, this is part of site plan number 422. It's Roslyn Plaza. This site plan was approved in March of 2016. It consists of 1.8 million square feet of office density, 550 multifamily units, 200 hotel keys, and 45,000 square feet of retail space. The site plan is required to proceed across 5 phases, which are spread across 25 years from start to completion. The owner is not able to proceed to a later phase until the prior phase is completed. So phase 2 can't begin until phase 1 is completed, and so on. The site plan also includes major public street improvements, including 2 new streets being built and new public parks. The site plan application was initially filed in 2009, meaning by the time of the 2016 County Board approval, it took at least 7 years to go through the site plan approval process. Phase 1 of this PDSP is a 588,000 square foot office with 12,500 square feet of retail space. Obviously, it is, again, a phase development. You can't move on to phases 2, 3, 4, and 5 that have the multifamily hotel and more desirable density until this phase 1 is completed. Phase 1, again, is 588,000 square feet of office. It also includes those major street redevelopments. So phase 1 is not an attractive site plan. Just from a market perspective, we've had Arlington Economic Development put out a report last year saying 51% of office space is either in distress or at risk of distress. We have negative net absorption 5 years straight in the Arlington office market. So really not a good market. There's a brand new office building at Quincy and Fairfax in Ballston. It's sitting empty. It's been sitting empty for over a year. So really not a good market to develop new office, especially against the backdrop of increased interest rates, increased construction cost, reduced demand, reduced rents, increased concessions. Clearly not a great market to complete phase 1. That means you can't start on phases 2 through 5 either. So the counties assess this property using a sales comparison approach. If you all have purchased a residential home, I'm sure you've done an appraisal, commissioned an appraisal. They typically use a sales comparison approach for that. You read through the appraisal, there'll be a list of 5 comparable sales, and they'll say, okay, these are comparable, and then they'll make adjustments to those sales to make them more comparable to the subject's house. The county's done a sales comparison approach with no comparables. They've just said this is the value. It's a sales comparison approach, but there's no comps. We just feel it's this way, and to account for the present value of the 25-year phase construction timeline, the county's assessment does make a discount for the future phases to account for that time value of money. But the initial amount, the dollar amount that's put in, has no sales comps to support it. Now, if you turn to page 25 of the appeal, you'll see our support for a lower value. These are actual sale comps. A nearby site plan, the Roslyn Gateway, sold in November of 2023 in a widely marketed arm's length transaction. The Roslyn Gateway site plan consists of 516,000 square feet of office FAR, 273 multifamily units, and 148 hotel keys. So similar to the subject property as far as unit mix, much smaller, obviously, not a phased development site plan. On page 27 of the memo, you can see a breakdown of that sale price by density type. Here you can see that the sale value of that fair market transaction in November of 23 valued the office density at $45.13 a foot. That does need to be adjusted because the property does have office tenants paying rent. That's excess income that the owner earns in and above the site plan value. So once you adjust for that excess income, that brings the office density FAR down to $36.42 a foot. Now that 4513 unadjusted value per square foot, that's supported by another sale. That's supported by 4420 Fairfax, which also sold in 2023 and was appraised at $45 per square foot of developable FAR. Turning now to page 26 of the memo, you can see the fair market value for the subject property derived from those fair market sales in the county indicates a fair market value for this parcel of $9,969,255. This value is reflective of the market for this amount of office density spread across a 25-year PDSP. So that's the case, pretty straightforward. The county's used a sales comparison approach to value the property, yet this sales comparison approach includes exactly 0 sales to compare with. It's just speculation that this is the right value. When you do actually look at the sales, you see that they support much lower values. Now, the burden is on the appellant. The burden under Virginia law is preponderance of the evidence. Preponderance of the evidence means more likely than not. So in this case, what opinion of value is more likely than not the right one? The sales comparison approach the county has presented based on 0 sales comps, or the sales comparison approach that we've presented based on 2 sale comps that occurred just over a year prior to the date of value. More likely than not that it's a sales comp, again, 0 sales comps provided by the county. If you had an appraisal for your residential house, they provide sales comps. They can't just say, this is the value. No lender would accept that as an appraisal. We did provide comps based on the market. The market's deteriorating for office product, as we've seen from office sales. We saw just this prior case, the 1320 courthouse, those bids. I put my reputation on the line when I testify here. I'm an attorney also. I have an ethical duty to tell the truth in these forums. Those are the bids, and I would have been happy to share them, offline with the board, but these sales are coming in much lower than the assessments. Office values have decreased. Office land has decreased as well. This property, again, has 1.8 million square feet of office density tied to it. If there's no demand for the completed office, there's no demand for office land either. Yet the assessments made only a $5 adjustment from pre-pandemic levels to the current level, going from $65 a foot down to $60 a foot. We know from market sales, those are actually coming in at about $45 a foot. And that makes sense. If you have an office and you have no tenants and your rents are decreasing, your costs are increasing, you're in trouble. Arlington County said that. They've said 51% of the existing office market's in trouble. Why wouldn't somebody go in and build more into this troubled market? So that's the case. We respectfully request the board reduce the assessment based on actual market sales. Thank you.
Okay, thank you. Mr. Peralta for the county?
Yes, thank you. This property should have been heard with other properties. This property is Roslyn Plaza C. It is part of the PDSP at the Roslyn Gateway area. The original assessment was based on site plan. We did value this based on the $60 per square foot per GFA for the 744 512 square feet of office And then the additional density of 1,065,661 and in office, and additional 45,000 in retail for that additional density at $60 a square foot. Now, it is our understanding that that the county's position has changed as far as recognizing PDSP that hasn't had final site plan approval at 4.1 final site plan approval. We did offer a reduction on the other two cases, Roslyn Plaza D and Roslyn Plaza E. Based on that change in policy, we do find in this particular case with Roslyn Plaza C that the cost approach which we use with the other two properties as well as the synthetic theater, I believe the owner for synthetic theater received a reduction and was signed off with the covenant that was offered with that case. In this case, however, when we did do the cost approach based on this particular building, we did find that even though we did use a depreciation of 77.5%, that deducted the total amount by about 31,942,562. It did result in a higher value than what initially was assessed as of 2025. You'll see in my notes there that the structure resulted in a value of 9,291,333, and then the land value is now at 8,552,640 for a total value of 17,844. And that is higher than the initial assessment, again, that was valued at 15,274,500. Therefore, we do ask that the board confirm the original assessment as it is a lower value compared to what the cost approach has shown. That is all. Thank you. Yeah, thank you.
Any questions from board members? No? Mr. Yates, no questions?
Yeah, I'm sorry.
Any final comments, Mr. Peralta, in a minute to wrap up?
Yes, I guess I misspoke. It was a signature theater, not the synthetic theater. Signature theater that had a reduction covenant sign. Thank you.
Okay. And Mr. Harmon, if you take a minute to wrap up.
Yes, thank you. So there's no covenant that was signed, so I'm not sure where Mr. Peralta is testifying to that. That never happened. We never received the reductions that he stated on the other properties. I don't know if those are coming down the line. We'll review those in due time, but no covenant signed on Spectrum Theater. Going back to this property, it's office land, primarily office land. That first phase is a 600,000 square foot office requirement. You can't unlock any of the further density until you build that 588,000 square foot office right off the bat. Now, looking at office valuations in Arlington County, what the market has told us that since the pandemic, on average, office values have decreased 53%. That's not based on assessments because the assessments haven't caught up. It's based on market transactions. That's the paired sale analysis study that we provided in the board book. Those are properties that traded twice, one in the years just preceding the pandemic, a second time right after the pandemic with similar vacancy, similar occupancy at both sales. That tells us the impact of the pandemic on these properties is about 50%. If you do that to the pre-pandemic assessment of this property, it gets you down to our value, 9,665,700. The assessments failed to account for the decrease in demand for finished office product, which in turn reduces the demand for raw land. Thank you.
Thank you. All right, it's just among the board. Where's everybody on this?
I'm okay with it. I mean, it still benefits the tenants and the owners to have this lower value than if it would have been assessed, like Mr. Peralta indicated, the 17 million or something. I'm okay with it.
The lowest it's been in least 10 years, so it's a slight reduction from last year, but I think I'm okay with it as well.
I understand what you're saying, I just didn't see where we could hang any. I don't like it, but I think it's probably what we have to do is take what the county's come up with. And the project's not gonna move.
So we want to make a motion.
I'll go ahead and move that we confirm the assessment at 50,274,500.
Mr. Mendez, all in favor?
Yeah.
Aye, opposed. It's unanimous. The county is confirmed at 15,274,500. Thank you. And then, Mr. Peralta, if you just would make sure that you get Mr. Herman the information on the reduction from the previous case.
Yes, I send it to Rosa and Rosa will send it to
Oh.
Jordan.
Okay. Okay, that completes the agenda. Does anyone else have anything? Okay, then we will stand adjourned here at 9:53 a.m. and reconvene next Tuesday, October 7th, virtually at 9 a.m. Thank you, everyone.
Thank you.
All right, thank you.